Good morning, everybody. Thanks for tuning in. Appreciate you carving some time out. It's really important to me to deliver value. And so I know we had a lot of people sign up for this webinar, but it's very hard to actually show up. So we're doing a recording and sending out the deck afterwards as well. But you'll definitely get the most out of it by being live and be able to ask questions and whatnot. So yeah, just wanted to deliver real value. What we're going to talk today is about tax optimization. Um, these are real items from the tax code that I go find and then I utilize. None of this is like gray hat stuff. This is just find out what the federal government wants you to do and then do it. That's basically my playbook. So okay, so this is the 2026 tax strategy update. Change what you own so you change what you owe. I'm going to go through real life examples today, so this is most tangible. I don't like pie in the sky stuff. I like implementable, actionable, like real stuff, and so that's what I try to provide to folks too. It's super important for me this to be interactive, so I've got the Q&A open right here. So as you guys have questions, I'll just answer them slide by slide. So super important disclosures here. I'm going to dive really deep here. I am not a tax accountant. I am not an attorney. I am not a financial planner. These are just my personal opinions. This is educational content only. Any numbers you see are based off of past performance. They're not a guarantee of future returns. It's not an offer to sell. And then how to use this material. It's educational. It's advice for you. Talk to your CPA. Okay, now that all the disclaimers are in there, I can really dive in. A little bit about me. So I was a former dentist, scaled a dental group from zero, to 160 team members. It was the hardest thing I ever did. It was very challenging. Over time, I just found that I loved real estate development. That was my passion. That was what I was good at. That's how I could add um, positive impact to my community, to the world around me, help my friends, help my clients with investing, with other things. And so that's what I do now. I'm a real estate developer. That's my primary role. I have over 500 units in development right now, over 150 million in development. I'm also a contractor. It's important to me to execute, and so being the contractor is a key piece of executing for the real estate development. We have an excavation company where we do all the dirt work before we build, and then I'm a fund manager. So I help a lot of folks invest and just build wealth and build freedom in their lives. So, okay. Um, so this is where my planning is for this year. So utilizing kind of where all my income sources are this year and my plan for this year on tax mitigation, it looks like I'll probably save about 1.8 million in taxes. I value our government, our state government, my city government, and my federal government. I really value many of the things they do, schools, roads, all these things are very important to society. And I'm so grateful to live in America and for all the things we have. Um, so I'm not against paying taxes. I pay a lot of taxes. But when I look at what I want to do with my life and making the most impact, if I can retain those funds and reinvest them, put them into new projects, I feel like I can have a lot more impact. And so I always just look at the IRS code. These are the things that the federal government wants us to do, and the IRS implements those things. And so those are the strategies I employ. So I change what I own, so I change what I owe. So the agenda today, we're got 5 sections to go through the playbook here, identify the problem and the value. And then I'm going to talk about 3 different people really. So tier 1 is like what every dentist can do. This isn't just for dentists, but I'd say 75% of my clients are dentists. So I tend to use those examples, either W-2 or owning a business. So these are things that people can do as a dentist. these are things that people can do once they start investing. You start turning off some cash flow in addition to your primary career. These are some things you can do. And then if you, I want to be very transparent, but also, I will talk a little bit about like the things I do, if you ever want to do that. And then, yeah, so that's going to be our main thing here. So, um, the problem. So, every guy, every girl typically save 50 to 250K in taxes a year as long as you're making, I don't know, 300K a year. Active investors, once you start making 750 a year, 1 million, 2 million, 3 million. These are most of my clients, folks I work with. You can start saving 200K to a million a year. You start doing the stuff I do, you can start making, saving a lot more. So why are dentists uniquely squeezed? Yeah, we don't make we don't make a ton, so we can't do what like the high net worth and the ultra high net worth, 30 million, 100 million net worth folks do. Um, and we have a lot of W-2 income, which is like the worst type of income. So, yeah, we've got a lot of challenges. For example, a dentist making about 750K at the end of the day keeps about 430. So you're sending a check to the state, the IRS for about 220, sorry, 320 a year. Often that's federal income tax, state income tax, FICA, Medicare tax, NIT. I mean, there's other things as well, but that's basically like the issue here. If you had that money instead of, sending it along to the state or the feds, I mean, you could really compound your portfolio, create income younger in life, get the freedom you want to do the things with the people you love, the hobbies you want to do. Um, the biggest impact here is in your peak earning years. So, when you have good income, a lot of folks kind of bleed themselves dry with taxes during those times. So we're going to talk a lot about what you can do during those times. And then also another big event for folks is when they sell their practice or their business. I'm going to go over one example of a friend who has a $15 million capital event right now. And I'll kind of walk through what we're doing to optimize that for them. So, so we're still defining the problem here before we dive into solutions. So this is the big point that I think most people don't grasp. To me, being like a finance guy, like a basic math guy, it makes a ton of sense to me. A lot of people come to me and where I just see posts online, they're like, okay, I think I'm gonna be able to like have 3 million bucks net worth or 5 million bucks net worth, and then I think I'll be good. That's my plan. I don't have high expenses, this, and this. And I think it's good that people have that intention about where they're going, but 3 to 5 million is just it shows me typically that they don't understand like basic math about what they could be doing. So, if you just kind of look at if someone's socking away 150 a year, okay, they're using, maybe they're making 500K or they're making less and they're just really good savers, really good at tax mitigation. You know, Historical real estate returns, and I could break this down and do that in other webinars, are about 16%. Most of our projects, we want to make sure they're at least targeting 20%. And our average annual return on our projects has been on the 4X, it's 47.4%. So I use these numbers because to me, these numbers are very achievable. But if somebody's socking away 150K a year for 10 years into something like this, then these are the numbers that people talk about, but folks are talking about over their whole career. And so what I'm saying is, hey, like you can do this much faster if you just do it with a lot of intention. Just get real intentional about your income, about your taxation, your investments. And then over, 20 years, most dentists practice, 20, 30 years. Like if you're doing 150K a year, socking it away, I mean, these are the numbers that I would expect to be seeing. If you're doing quite well, you're making maybe $1 million a year, you're socking more away. Again, after 20 years, these are the numbers I would expect to see. And if you're doing really well as a dentist or another income earner and you're socking a lot away, over 20 years, this is what I would expect to see. So, um, this is really what I'm talking about. This is kind of the why we're talking about taxes because our lives are short, our health is not guaranteed. We hear so many folks who retire. I just this week, the CFO of the largest private bank locally, Washington. Oh, I shouldn't say names. In Washington, he went in to have some surgery, and it was not a major surgery, and he had a stroke during the surgery. Right, just retired last year. Very successful guy. We don't know how he's going to recover. I mean, these things happen. So the point is, like, you got to live. Um, Life throughout. You can't just focus on retirement. You got to make your life good while you're young, while you have health, and you got to keep your health up along the way. And so, by enacting a strategy like this, you can retire much earlier in life, or at least when you go to work, if your net worth is, over here after 10 years, when you go to work, you're not as stressed, right? You know that you're good in life, you're covered, your expenses are covered, your retirement's covered, and now you can really just work on serving people, adding impact to your community. And so it's just a great mental health thing, frees up time to go to the gym, frees up time to spend time with your family. So this is really where I want to help people get to so they can live their best lives. So good. So that's pretty much the problems. I think this is the last problem. Say what's not in this webinar. I mean, yeah, I heard a bunch. I'm just a very curious person, but you listen to all this stuff when you're in dental school and when you're getting out. People talk about captive insurance, conservation easements, oil and gas, moving to Puerto Rico, the Augusta rule, cost segregation on homes, like all these things. There's so many things that people talk about. I don't like to major in the minors. I'm not going to spend a bunch of energy on stuff that have a small amount of impact and are also like government challenged. Conservation's easements, the feds have been going after these captive, different types of captive they've been going after. These you got to be super careful about operators. I don't want to move to Puerto Rico for 51% of the year. I don't want to try to take a tiny little thing that helps me a little bit and abuse it. So we're really going to focus on a ton of stuff, but we'll talk a little bit about cost segregations. We'll talk about grouping election. We'll talk about bonus depreciation a ton. That's a massive one. We'll talk about opportunity zones. Those are fantastic. 1031s, real estate professional. Talk about this stuff and a lot more. Okay. Okay, we are about to dive into the primary content today, but in life, every time I ever look at anything, I always start at defining the problem. If you start jumping to solutions, it's just very inefficient. It's always about defining the problem and what are the consequences. So that's really what I was trying to do at the beginning of this webinar. Anybody have any questions about the problem before we dive into solutions? And if you raise your hand too, if you'd rather chat, I can always just hit this allow to talk button. So feel free to do that as well. Okay. I do want you guys interrupting me as you have questions as we dive into the content. So please do. Okay. Thank you, Andrea, for giving people the ability to chat. Okay, so let's talk about the DIY person. So this is somebody who's a W-2, maybe owns their own practice. They're not like heavy into investing yet, at least not into real estate and alternatives. Maybe they're doing some, basic dollar cost averaging into index funds or something. So let's talk about this to start. Most of us in as dentists who own our own practice, the first one is, you say what your W-2 wages are, which is like usual and customary wages. It changes, it goes up over each year, but let's say 250. Anything above that, you're not paying the extra 15% on your like self-employment wages. You're paying like half that. So this is a good one. If you're not using this and you're making 750, etc., you should. Sometimes I see people not pay themselves a W-2 at all. When I research that, it is typically like an IRS audit trigger. But I mean, I talked to a guy this week. I mean, him and his partner, they're up in the Northeast. They don't do this. They just pay themselves distribution, so they're not paying all of this. So you don't really talk to your accountant and decide what you want to do. It's not a massive impact. Just depends what your income is, I guess. But it's definitely helpful and it's definitely, above board. And this is a good one. Defined benefit cash balance. We see these in our Facebook posts a lot. I mean, I looked into this. All these have like a lot of administration things, and it's just a lot of work. Right now, you got to manage it. Now, when you're younger, it doesn't really help. It's really when you get to the end of your career and your team is much younger than you, that I can see people sock a lot of money towards the end of their career into these. So I wouldn't really waste time looking at this unless you're like 55 plus. But if you are, then it's a decent deal. But again, just know you're in it for the long haul. It's not something you can bop into and bop out of. So it really ties you up. This is a common one I've seen people, not everyone understands one because it's a little complex, but it's helpful. So you have different income buckets. You have active income, like things you do with your hands, your energy. You have passive income, okay, things that like checks, mailbox money, and then you have portfolio income, like stocks, bonds, all those kind of things, okay? Generally, you got to match your tax benefits in the same bucket. So, like active income needs to be addressed with active tax strategies, and passive income needs to be addressed with passive tax strategies. There are some like areas where they kind of overlap, and one of them in dentistry that's common is if you own a practice and you own the building, you're going to buy the building you're in. Usually real estate income is passive and dental income is active. But if you buy the building or you own the building, if you check this box, the 469 grouping election, you can actually tie your practice and your building together. And then you can do a cost segregation analysis. Let's say your building's with a million, 2 million. You're typically on a $2 million building, you're typically going to get about 600K in depreciation in year one, which means you get to take that 600K off your dental income, just that one time. Next year, it'll be quite a bit less. Maybe you get to take off 150 instead of 600 off your dental income. But this is a good way to utilize depreciation from the building you own. I know this isn't groundbreaking, but I am trying to hit like the solid ones that people can do that often I still see people miss. Any questions on any of these three so far? Raheel, does that work if we only occupy minority space in the building? Yes. Remember, I'm not a tax accountant. These are just my personal opinions based off my research as I answer these questions. Yes. So it's a pro rata. So if you occupy half the building, then you can utilize half that depreciation because you occupy half. Great question, Raheel. Any other questions on these three? Okay. Equipment. So this is probably the most impactful for W-2 and practice owners that aren't like heavily involved in investing. Um, so this used to be called Section 179, but with the Big Beautiful Bill, they made a bonus depreciation 100%. It pretty much deletes. the Section 179. It's still there, you just don't use it. You just use the bonus depreciation. But yeah, think about in like your dental office or anything else, you buy like a, $100,000 machine, a scanner, a CT machine, something like that. You can depreciate all 100,000 of that year one, right? And most people, most dentists have seen that who are owners. They understand that. The equipment reps make that very clear in Q4 of every year. Hey, buy something and take it off your taxes. It's like a 35% discount. So that's all true. The problem is in dentistry, if you ever try to sell your practice or buy a practice, you'll notice that most of the value of the dental practice is goodwill. Okay. And goodwill is like your relationship with patients, the chances that they're going to come back, right? Have you pre-appointed? Are they coming back? That's the most value in a practice. The problem with goodwill is it has terrible tax treatment. The IRS does not say, the federal government does not say, wait, we want you to have goodwill. What the government says is, hey, the feds say, hey, with bonus depreciation, what they're saying, what you can hear Trump saying, if you ever listen to when he talks about this stuff, he's saying is like, we want people to build factories. We want people to invest in infrastructure. So equipment, like manufacturing equipment, construction equipment, all of those things, equipment for growing businesses. We know if we give you tax breaks now, and you buy more equipment and utilize that equipment, it's going to create much more tax revenue for us in the future. It's going to grow the GDP of America. Okay. So this is why they do this, because they want to incentivize growth. Okay. So if we're in dentistry or we're W-2 and we just don't have a lot of equipment, then it's hard for us to utilize this. So what you got to do is marry your W-2 or marry your dental business or your other business that has a lot of goodwill with another business that has a ton of equipment, a ton of depreciation, right? So manufacturers, equipment rental businesses, their entire value is a lot of it is their equipment. So it's really a very yin yang, synergistic um, model to marry the two worlds together. So I do this every year. I've been doing this for about 4 years. It's been very impactful in my life. The challenge most people run into is time. So if you look at like the requirements for this, unlike a real estate professional, which we'll talk about later, where you need 750 hours a year and more than anything else you do, which is pretty much impossible for a W-2 person or an active dentist. This program, you need 100 hours, and that's pretty easy to get. If people have questions, I can answer them for you later. And this is, if you've ever looked at like oil and gas, this is about on average 8 to 10 times more tax efficient, more effective than oil and gas. So when people ask me like, do you do oil and gas? I'm like, oh, I've done a lot of research on oil and gas, but no, like, why would I? This is like 8 to 10 times more tax efficient in most cases. And it's with, I partner with like low risk, like publicly traded companies. So they're completely transparent. All their financials are transparent. Where the oil and gas, you can get with a really good operator who happens to hit oil and things can work out well, or you can get with an operator who isn't so good, or even a good one and they don't hit oil. So this is just a much more straightforward, predictable, lower risk strategy. So the impact here is typically, you put in 65K in cash, you buy $500,000 worth of equipment with that 65K, and that allows you to take that 500K off your income, depending on your income levels. Let's just say 40% between federal and state, you're saving about 200K a year. And then that 200K a year goes into this, right? Now you're investing it, now you're compounding it, and now you're creating wealth and freedom for yourself. So that's um, the strategy and the impact. Any questions? Mia, what is Own a Fleet? Own a Fleet is a business I set up. So when I started doing this 4 years ago, at first I started doing it with like local operators, but it was really hard because I had to like vet them, manage them, just make sure that they were renting out the equipment effectively. And, it's just a lot. Eventually I found like I said, a publicly traded company that operates nationally that also was fantastic. So I set up a business with them, and Own a Fleet's the name of the business. So it's managed rentals. So it's basically done for you equipment rentals. So you use that strategy without all the stress, and you just got to do your 100 hours. So it's much easier. Will the equipment capital come from personal or business accounts? So the IRS requires personal guarantee. Like you have to own the equipment, you have to be at risk for the equipment. And so I usually, not a tax professional, but the easiest thing that I've seen typically is just to set up a new LLC. I usually like to do partnerships. I usually have my wife on it with me. That just makes the whole taxes thing a little easier. And then that LLC owns the equipment, and then I have a contract with through Own a Fleet with um, the managed rental company, and they manage it. Will the tax efficiency come from tax deductions or credits? Deductions. So you deduct like the 500K for every 65 that you put in. So good question. Any other questions on this one before we go to the next one? Yeah, so if you look at all the big rental companies, they make more money on the used equipment than they do on the new. So my rental partner buys it back typically at 6 years, typically at 54% of original purchase price. That allows you to pay off the loan and get most of your funds back. And then that is a taxable event that year. And so there's a lot of strategies we can talk about how you keep that going. Wondering the advantage to do with equipment. Yeah. Abraham, EquipmentShare is my national partner. You just can't go to EquipmentShare directly. They're a $4 billion company. They they love this program they have, but they're not interested in working with people directly. So yeah. So I just set up a business where we have enough scale. I mean, I think our last fleet we got from them was 100 million bucks. So if you're buying 100 million from Equipment Share, you could probably go direct. But if you're not, that's why I set it up. It's just I could never bring my friends into what I was doing locally. It just wasn't predictable enough with local operators. Um, but when you have a national company that's been doing it since 2018, it's just trucks. Yes, I also do stuff for my excavation company. We buy things that we use a lot, like skid steer, excavators. I don't know. I think we have maybe like trucks, maybe 5, 6 pieces of equipment. But on a development site, maybe we need those five. Those are like our bread and butter. But then there's like five other ones that we need that only need it for like 2 weeks. So we rent. Most construction folks rent, and we actually rent from Equipment Share directly as well, which is not related to this, but we rent with them. They're great. Um, Tax credit opportunities. No, I don't think I have tax credit opportunities in this one. But I mean, if you have questions about tax credit stuff, we can talk more. Um, yeah, this one's focusing mainly on deductions. And then Damon fleet of trucks, three categories typically: aerial lifts, if you're cleaning windows, changing light bulbs, redoing the scaffolding on a building. Those are the most popular. And then there's like moving stuff like forklifts. And then the third category is like dirt work. It's like skid steers, backhoes, all those kind of things. Yes, we'll be sending out a replay anonymous. Um, okay. Any other questions on this one? And I have a whole webinar. If you just go to ownafleet.com, it's pretty good. I kind of cover things and yeah, just go to ownafleet.com. I don't want to get too focused on just one thing here. So you can always call me, text me, whatever, have my number at the bottom, set up a call and we can talk more. This is one that like almost no dentists talk about. So this is one you probably have never heard of, but this is because I talk to a lot of people outside of dentistry and all sorts of business. This is very common. So um, a lot of dentists will sell their practice and move to a new area to start a new practice, or they'll start a DSO. Two great opportunities to utilize. One is called ROBS. You like use your 401k money to start a new business, and then it's pretty much tax free on the back end. So if you're thinking about starting a new dental office and you have some money in your 401k, I would definitely look into that. Another one that people miss is opportunity zones for setting up businesses. So opportunity zones are not just real estate. We're going to talk a little bit more about those. I use them a ton, but they're also for businesses. So let's say you open up the Opportunity 2.0, Opportunity Zone 2.0 map. It'll be finalized in December, but if you look online on Google, you'll find some maps that are pretty accurate on what they will be. If you open up a business in that area with capital gain money from selling your other practice or selling stock or something else, you can make your new dental practice or your DSO tax-free on exit if you hold it for 10 years. So these are two things I don't hear people in dentistry talking about that folks do in other industries that are super valuable. Any questions about these two? No? Okay. The idea always is you don't want to pay taxes on the back end. Not paying taxes today is great, bird in hand. Not paying taxes in 10 years after you've built your dental practice from zero value to $20 million in value, and now you're selling it tax free or any other business, that's super valuable, right? That's going to save you, if it was worth 20 million, that's going to save you 5 million in 10 years. So there's a lot of value in these. Abraham, if you Google Opportunity Zone 2.0 map, you'll see like there's a few like tax firms, consulting firms that just offer free mapping. And you just click on the link and it'll click on another link and it'll take you to a map to kind of show you. Opportunity zones in general are just lower income census zones, but within a zone, sometimes like half the zone is actually high income, half the zone's low income. So you basically just pull up the zone for like where you are in the country or where you want to open a practice, and you can just see like, oh, could I open a practice or a DSO headquarters in that zone? And that's how you do it. Rob's. Yeah, there's people that do these. No, 99% of CPAs just do the basic stuff, right? So you got to go and find folks doing Rob's. So just Google that and find like the top firms that do it. I know one guy, that's very active in that. OZ, I have a fund, so you can either set up your own fund or you invest in somebody that has a fund. There's different ways to do it. A couple OZ in Washington you like. So opportunity zones are just like census tracts that are qualified, right? It's like piece chunks of land. The bigger room says do this. Okay. Then what somebody does, first they create a fund. Okay. So like companies create funds. Like I have two funds, about to create a third. So I create a fund, someone else creates a fund, and then that fund pools money, tax advantage money, like we're talking about, and then that fund invests in different real estate entities or different business entities that are within these opportunity zone tracts of land. That's how it works. So Dan, when you say can you name a couple OZs in Washington, if you're talking about tracts of land, just look at the map. If you're talking about funds, well, I don't know. I mean, I just probably Google opportunity zone funds in Washington. Um, most of my all my OZ properties are in Washington, but I usually set them up in like Delaware or Wyoming. I think Delaware for my OZ fund. Can you open up an internet-based business located in OZ? Um, as long as like the people who work there, George, go into the OZ, like if you set up an office, right? And the people that go there, I forget what the numbers are, let's say 20 hours a week, right? And they go into that office a majority of the time, 21 hours a week. If they work 40, I can't remember the exact rules, but something like that. So yes, as long as the business itself is there, where they operate, or how they interact with the rest of the country is not as important. So, no, OZ strategy cannot be done retroactively. I'm sorry, Abraham. That's what I'm trying to get the word out now, right? But practice the next practice. You did. You could do it. So, great question. Yeah, this is one that like is completely underutilized, both of these. So, okay, any other questions before we move to the next one? Okay, we'll talk more about this, but OZs are awesome because it's like a Roth IRA. It's like tax free on the back end, but it doesn't have all the terrible Roth IRA rules. Okay, real estate professional status. Most of you have seen these in posts. Yeah, I mean it. Just Google for how to find the OZ areas. Just Google Opportunity Zone 2.0 map. Opportunity Zone 2.0 map. And if you do that, you should be able to see a map of all the opportunity zones. It's where they think they're going to be because the government already released the census data they're going to use to determine them, and they released how they're going to pick them. So the maps you're looking at just merge those two together. The one thing that we're still waiting on is all the states and municipalities have the opportunity to say, hey, we'd really like this piece to be one too. And so there's a process that they go through, and I think all that has to be done by December. So the final maps will be done in December for OZ 2.0. If you type in OZ 1.0 map, those are the current maps, and those maps are valid for another 2.5 years as well. And so if you're looking, um, yeah, so real estate professional status. So this is another one of those areas where the federal government heavily incentivizes folks to do real estate, just like with equipment. They want buildings to be built, new housing, new businesses. Like the government wants this. So what they allow you to do is use bonus depreciation to depreciate a lot of your real estate in year one. The simplest example is if you buy a building for 10 million bucks. If it's retail or apartment, I usually see about 2.5 to $3 million in depreciation the first year with a cost segregation study completed. And the cost segregation study is just something you hire an engineer to do. They kind of stuff all the depreciation schedules into the front end. It's completely above board. It's yeah. And so this is one of the major tools I use. The hard part is that you have to be doing real estate for 750 hours a year, and it's more than anything else you do. And it's got to be like operational, like you got to be involved. And so, if somebody's spouse is like a real estate agent or managing their real estate properties, that works. Or if a dentist cuts back on their hours, so they hire an office manager for their office manager is running the office, and they're only working one day a week or none. And then it's very easy if you have properties and you're involved in them to show that you're a real estate professional, and then you can take all that depreciation and write it off against your dental practice income. And so, um, if you don't have this, if you're not doing the 750 hours, your income from real estate is treated as passive income. So it only can be used against your passive income sources, like other real estate. BC for OZ, after 10-year gains are tax-free. Yep. But you still owe state tax in California who doesn't conform. Oh, California. Uh, so BC, yeah. So certain states, there are a couple, yeah, a few that don't. Like the feds say this, and the states say, nope, we want people paying as much taxes as possible. You see, I actually have an example of a friend of mine who has a $15 million gain, and we're going to go over that slide. He lives in California, and so I'll kind of show you we're still doing OZ because it has a major impact, just not on the state tax piece. So you still get the federal gain, you just don't get the state gain. So I think that example of this $15 million equity event capital event will be super helpful for you. Any questions about real estate professional status? This is a complex one. It's not complex, but yeah, it's a little complex. People have been talking about this one a lot the last 3, 4 years. So um, I don't think this is new to most of you, but if it is, I want to make sure I'm answering the basic foundational questions. So why I like equipment versus real estate is it's much easier to hit. It's 100 hours and it doesn't need to be more than anything else you do. So that's why equipment, you can pair managed equipment still being a W-2. You compare managed equipment still running other businesses. So this is one that's much easier for folks unless they have the ability to do 750. How do you track 750 hours? Good question, Mina. So, I've been all in on real estate as a developer the last 2 years, 2.5 years. I've been doing real estate since 2018. I've never met a real estate individual who tracks their hours. Not one. Developer, contractor, broker, you name it. Never met one who tracks their hours. So the initial answer is most don't. Every accountant you ever talk to, when you talk to them about your hours, though, for equipment or real estate, are going to say, hey, you got to track your hours, right? Because that's what the IRS rules say. How do you do it? There's softwares out there now, there's apps. You can just use a spreadsheet. It's really however you'd like to do it. If you have a property manager, no, you have to be involved in the property management. Again, not tax advice, don't talk to your CPA, but you have to be involved in the management. So if you are, you know, part of the LLC that does the property management, there's one example. We could dive more into this one, but yeah, you have to have some like operational ties because if you just have a property manager and they do everything, then it's passive. It's not active. So, but yeah, I mean, if you're involved in the management of the properties with a property manager and you're actually doing things, then you could definitely build a case around your 750 hours, especially if you got a few properties. So again, this is above board. This is the federal government wanting us to build buildings to grow the economy. So that's why I love this one. Mina, yeah. So Mina, great question. So Mina asks, for someone starting now and working 4 days a week clinically, do you recommend scaling back or qualifying through managed equipment? So I'm going to give you my 1 minute um, solution for most dentists. Okay. So the 1 minute solution is, I grew one large practice and then I grew a group. Okay. And after doing both, I will tell you growing one large practice is the way to go. I have a buddy whose our practices at like year 5 or year 3 were the same size. I decided to add other practices. He decided to focus on his one practice. Went much better for him. He just texted me 14 million. His revenue is 14 million this year out of that one practice. And as you know, when you're in one practice and you're focused on one practice, your overhead goes down a ton, right? So I don't know what his income is, 7 million from that one practice. So it's really important if you're trying to create good quality of life and really serve your team, serve your patients, is really, I would recommend focusing on that one practice. Really learning insurance inside and out. That's one thing most dentists don't do. Focus on insurance, focus on some sort of treatment that people will pay for. Typically, that's implants. And then grow your team. Bring on other dentists to work with you. Typically, the associate model, the partnership model gets a little complex and challenging. So if you do that, Mina, and you work yourself out of a job, you can never delegate profitability and you can never delegate culture. But you can delegate a lot of the operations to your office manager, and you can bring other dentists in and help them have a great quality of life and a great income without all the ownership pieces, and free yourself. And now you're not earning a W-2 from your business, right? You're just getting distribution checks and you have an office manager in place. So the story is like, hey, I'm not there. This office manager is there. These dentists are there. I'm getting whatever your income is in profit distributions. And then now I am a partner on all these properties, right? On these 4 or 5 properties, I'm involved, I do these things. And then it's really easy to tell a story that makes sense, right? Any questions about that, Mina? Okay. Nope. And again, everybody's situation is different, but that's like the most common solution that I see. Okay, you might be saying to yourself, what about this? What about this? What about this for reducing taxes? There are 1,000 different little things to do taxes, but again, I don't want to major in the minors, okay? But I did want to mention a few of these. I think putting your kids on payroll, having them work and paying them. Every time you can pay your kid tax free up to 16,100 a year, right? So if you got 5 kids, I mean that's 80 grand you can not be taxed on. And now you're investing in your child's IRA, Roth IRA or whatnot. Maybe they can use some of that money to buy their first house. If they ever get disabled, now they've got a chunk of money that's growing throughout their lifetime. So they're going to be taken care of. So this is a great one that I highly recommend. HSAs are good. Yeah, you can do this solo. No, that's wrong. You can't do a solo if you have employees. Solos are great if you do, but just like a 401k plan, mega backdoor, you can do that. But again, a lot of complexity. You get tied down with those. Augusta rule's okay. I don't know if you want everyone at your house or one of your properties. HRA is another option. Spouse on payroll. These are probably my 2 favorite out of these. And there's a bunch of other little ones, but I wanted to just mention some of them. Do they have to file tax forms? Gosh, how did I used to do this? I used to do this a ton every year. There's 2 ways to do it, Mina, and I can't remember what they are. I apologize. Talk to your accountant or just look it up on AI. It'll give you the full breakdown. But there are 2 paths. They're taxed differently on the 2 paths. At the end, they end up being about the same, so it doesn't really matter what path you take. But there are 2 paths on that one. So. Okay, so we're still on like the DIY, Dr. Smith making 750K. Just wanted to kind of summarize it. Dr. Smith is married, 2 kids, owns a practice building that's worth $1 million, spouse not on W-2, lives in a 10% tax state, runs a basic 401k. So this is like the most vanilla type of successful dentist. Yeah, so this is how we're gonna look. So if he doesn't do, if Dr. Smith, him or her, whoever that is, doesn't do any tax planning or not much, they've got their S corp in place. Okay, so let's say their income total practice income between their like the W-2 income and their Distributions is 750. They've got a 401k, they're saving a little in taxes. They haven't done a cost seg or grouped, but they are getting some tax benefit from their building. Their taxable income is about 702,000, so they're going to pay about over 200 in federal tax and 10% in state tax. So their total tax is about 292. Depending on the state, right? This number is pretty normal. But we already talked about this. What if you could take that 292 and invest it every year at 16 to 20%, compound it? You're going to have a good sized next egg, create a lot of freedom in your life. So another thing you could do is here's your same income. Let's say you're doing the equipment. Maybe you have 80K in equipment income as well. Let's say you bought 500K in equipment that year. Well, you depreciate all of it. So you get to take that off your income. This typically for W-2, this usually max out at 500,000. You can look it up. It's called EBL. For business income, I don't think there is a max, but just for W-2, I usually see 500K the max on most people's tax returns. You can do a cost seg in the grouping election, save yourself another 200K this year. It's a one-time thing though. You could buy some equipment for your office, and then the 401k, your taxable income is 1,000, so your total tax is 0. Okay. So again, this 292, sorry about making you sick with the scrolling. You put it into here, you invest it, right? This is why I love real estate because returns much higher than stock markets. I was honors finance in undergrad. We can talk about that. That's another seminar, but I mean, this is after 10 years, after 15, after 20. I mean, think how much freedom. I mean, you can do what you want when you want with, you know, the people you want. So super helpful. Okay. Any other questions before we move to the investor profile? Good. Okay, this is when you have capital to actually deploy. So tier one, it's more about your W-2 and your practice. Tier two is when you start doing other things, real estate, private placements, opportunity zone funds. The savings get bigger because you're following these IRS rules. Okay, the first one is a 1031. I can't remember when 1031 started, but like 1980s, I think. A 1031 is when you sell a building. It only works with buildings. If you sell a building, any of the gain that you made on that building, you can roll it into the next building and defer the taxes. Okay. So the way to get good returns is one, you just get lucky where values go up, or you add value. And that's what I do, right? I add a ton of value. I completely take a building and change it, make it look nicer, bring in a bunch of new tenants. We got one this year that we bought. It's a retail strip in Florida. We bought it at the end of 2024. It's right on, like, what is that? Highway 101 or 101, like right along the coast outside of St. Augustine. It's like a great location between St. Augustine and the beach. The owners hasn't raised rents forever. They weren't doing triple nets. So we took the average rent like $15, and I think now we're at $28 per square foot rent. So 15 to 28. That's called value add. Once you do that, you've created a lot of value. But if you sell it, you got to pay the taxes, right? So what we do is we sell it and either use a 1031 or we use opportunity zones to defer those taxes. So we can keep those gains compounding without taking out a chunk of them and sending them to the IRS. Once you send them to the IRS, you never get it back. Okay? So again, this is a very above board thing. These have been around 30 years, very popular. The pearl that I've learned on these is don't sell your building and then now you're on a 45-day clock to identify your next purchase. That's a very tight window. The best way to do it is actually find what you want to buy first. Put it under a longer term contract, okay? 9 months. Once you have a building you really like, you have it under contract, then sell your building. Once that sells, now you roll your money to the building you've already identified that you loved. It'll save you a lot of stress. It'll save you making bad decisions. That is my pro tip. Any questions about 1031s? Okay. So the value here is when you sell something within a year, it's short-term capital gain plus state tax. That might be 40, 50%. So you might have made a million, but you're giving 40 to 50% of that back to the IRS. Okay. If you do a 1031, you're taking all of your million and compounding it. Okay. And just deferring taxes. And most people try to defer it until they die and then they never pay it. When you're part of a fund, how does a 1031 work? So the kind of the interesting thing about 1031s is everyone has to 1031 together who's an investor in that property. So there are a couple strategies out there. One is called a drop and swap. One is called a swap and drop. It's where you kind of drop the folks who don't want to be in and roll their money. They just want to pay the taxes, and then you roll everybody else into the next project or vice versa. That's how it's typically done. The other option, especially if it's a smaller property, it's just not worth all the legal fees and planning with a swap and drop or drop and swap, is to do the opportunity zone fund. So great question, Damon. Any other questions on these? Okay, so great for real estate. But what if you aren't selling real estate? What if you have a big like stock event or you're selling your business, right? You can't 1031 businesses. So it took me a long time and a lot of research to figure out the best way to sell a business for myself. So everything in here is like stuff that I've learned that I'm like, this is the best stuff I found. I'm a honors finance undergrad. I love this stuff. I'm very curious. So I'm always asking, always looking at new stuff. This is the best stuff I've found and implemented. So you can do this with real estate, or you can do this with businesses. Okay. And opportunity 2.0 is what I'm going to focus on. That starts January 2nd. Okay. So if you had a sale out of a partnership this year or a sale out of like a single member LLC or a personal sale after July 6th, then all that money can be put into an OZ 2.0 fund like January 2nd of next year. Okay. What's great about OZ 2.0 is the capital gain tax that you would have had to pay for this year's event or a future event, you get to defer that for 5 years. So you get to take that money, time value money, and compound it for 5 years. That's huge. You could double that money in 5 years, right? And then pay the tax if you want it. So it's a really good strategy. Other ways people pay the tax in 5 years is typically if we're doing a development, you often get cash out refi money, depending how we structure it. Cash out refi money is tax free, so you can use that money to pay the tax. Um, Other options is we sell within the OZ fund, we sell the asset, the building, and then pay the taxes and reinvest the money to keep it for the 10 years into the next property. Equipment. Equipment creates depreciation, like we talked about. The character of that depreciation, if you buy the equipment the previous year before your taxes due, typically you can use that equipment depreciation. So in year four, if you buy equipment, you can delete it. Or, the IRS always comes up with new stuff, right? And so, 5 years from now, what's new? So there's lots of different strategies. Solar is another one that's actually still works pretty well. Lots of stuff. So, but the big thing here is you're not paying taxes, you're taking that money, you're compounding it. And then the huge one on this is everything you make over those 10 years on the back end is yours. You can take it after we sell, you can take it, you can keep it in the fund and keep compounding it tax free. There's no capital gain tax, there's no depreciation recapture. So this thing is massive. There's been 100 billion invested in opportunity zones in the first program. Now that it's made permanent with the big beautiful bill, you're going to see this thing over the next 10 years. You're going to see it in all sorts of structures. It's going to become way popular. So this is the best way to sell a dental practice in my mind by far. If you are interested in investing in real estate, Like just whatever you say. You say, hey, I want, a third of my money in dollar cost averaging into index funds. I want a third of my money into operating businesses like your dental practice, and I want a third of my money into real estate. Then okay, then just roll enough into this that it equals a third of your portfolio. So pretty straightforward. Yeah. Yep. Portfolio. Yep. Yep. You can sell stocks, Damon. The example I'm going to go over next, the $15 million example I'm going to go over is stock. So this is massive. And if you're thinking about investing in real estate, you can't let the tax tail wag the dog, but if you're going to put like $1 million into real estate, why put it into real estate that doesn't have these tax advantages? Why not just find a good deal in an OZ? So now your million's still going into a good real estate deal, no difference there, but now you got all this extra tax advantage. So to me, I try to do as much OZ as possible now. So we talked about practice sale. Um, yeah, like if you sold your practice, got 5 million bucks, a bunch of it's going to be goodwill. Maybe you sold 1 million from your building, um, some equipment recapture from the stuff. So like basic numbers, if you're selling for five, maybe your tax bill goes from 1.8 million to 300K, right? That's an extra 1.5 million that you can compound. So yeah, Damien. So great question. So OZ, so basically, I mean, personally, I tend to just do stuff around me now because, like I said, my average annual return on my four exits are 47.4% a year. Okay. And I grew a dental group from 0 to 160 team members. So what those two things have proven to me is if my hands are on it, on average, my returns are going to be good, right? Significantly above average. So what I do now is I go and I look at the OZ maps around my area, right? Within, where we want to build, maybe hour and a half. And I say, okay, um, within these zones, what could I build that's going to do really well, right? And then how can I have competitive advantages over the rest of the market? For example, right now, we have an OZ project that I think they're trying to close on the loan today. They keep emailing me. Um, and that'll be like 94 apartment units. It's 5 minutes from my house. It's a great neighborhood, halfway between the U District with Gonzaga, all these universities. And my house is in like kind of like the older district in town, old, beautiful homes, lots of trees. It's a great location. And so I just know that it's going to do very well, and it's in an OZ zone. Okay, great. The other thing I've been doing is I've started doing about a year and a half ago partnerships with state agencies. So if you reduce your market rate rents to, let's say, 80% of market, now that's like workforce housing, like families who make 80K a year, the state, the local cities will give you a lot of money as well. So that's another thing I look for. Is like, can I build something that's going to have a lot of community impact that the city, that the state want to give me, $2 million for? So that's another way to make something a good project. But really, this is kind of the special sauce is you have to understand people and you have to have a vision for something that's not there, right? That's one of my unique abilities. I don't have many. You can ask my wife, but one of them is I can see a piece of dirt and I can see what the highest and best use is, right? Like this is what's going to do well here. And then I get a bunch of stakeholders together and we build it. And just like that one in Florida, I mean, I was like, this is a fantastic location. Like the rents on this are way lower than they should be. Like I just understood it. I've done a lot of retail. I was like, we're gonna crush it. I think we're gonna try to sell that this summer. I mean, everybody's gonna probably double their money um, since December 2004. So double their money in less than 2 years. So you just have to understand real estate on deep level and consumer, like what people want. And then my next webinar is like how not to lose $500,000. And so I'll go over like due diligence, how I vet partners, how I vet other operators, those types of things um, to really surround yourself by like top tier folks. So good question. Any other questions on OZ? I mean, at the end of the day, if you just think about if I'm putting $1 million into a property, okay, and we just use like the 20% rule, that $1 million after 5 years is going to turn into two. And then after 10, it could turn into three, right? And it doesn't mean it needs to be one project. You can actually sell, like I said, and then turn that two into four if it makes sense. But at the end of the day, if you're not paying depreciation and recapture, you're not paying capital gain tax, the math is usually around like 35, 40% boost to your profits, right? So it's like if I was going to make, I don't know, 2 million bucks on this deal, now I'm making um, 2.8 million. Why
We
not?
can go. Whatever. I'm gonna do this, and then when they come over, I'll have a shower.
I don't think he's talking to me. Okay, cool. Um, Great. So ask questions as you go if they pop up. Depreciation from real estate partnerships. So yeah, depending on if you're active or um, passive, you just kind of want to match those two pieces. So if you can be active in real estate and you have active income, it makes sense to try to be active in real estate. If you have a lot of passive income, you probably want to be passive in real estate so you can match those losses. Real estate, in my mind, is better than equipment. Equipment is fantastic when you're um, in that first scenario. I like real estate a little bit better because the value of your real estate is growing at a much higher rate typically than the stock market. So you're compounding your net worth and getting tax advantages. Where with the equipment, it's a real business with real equipment that you'd be able to see. It's really cool, the software tracking, but at the end of the day, you don't make a ton of money off the equipment. Where you make the money is the money you're not sending to the IRS, you're compounding, right? You're investing it and compounding it. So that's what real estate is. It's a way to invest and compound money in a very tax efficient, in a very um, higher on average return, is what I've noticed personally when I do all my research too. Um, I was honors finance. I'm not against stocks, but investing in stocks is straight up gambling. It doesn't matter who you talk to. Silicon Valley guys, the smartest guys out there, it's gambling. And then, dollar cost averaging into stocks. I mean, that's the way to do it if you're going to do stocks. And it's a forced savings plan. It's a decent return. But if you think interest rates are, let's say inflation's 4% and the average historical stock market return is 8%. Well, 8% return minus 4% inflation is the net return of 4%, which is fine. But most folks who aren't gambling don't get rich off of dollar cost averaging. It's an effective savings plan. So, and it's liquid, so you can get your money back out. That's what I like about stocks. It's simple and it's liquid. Real estate is not liquid. It's more of a like I'm committed type play. So, any questions about real estate partnerships? Do a ton of these, so this is my world. So happy to report. Okay. Here is an example of a friend of mine. So I got two friends right now that are selling. One's got this 15 million and another one's got a $25 million deal. So I'll just run through this so you can see kind of what we're talking about in action. So this is a dentist. They invested in a small company they know and they got really involved in the company. And so They're getting 14, 15 million from a sale of that company this year. A lot of that is principal they put in. Um, and then that would be about 4.4 million, and the remaining is gain. Okay. So these are capital gains. They're short-term capital gains, which in California is like 50%, super expensive. 50, gosh, even more for him. It might even be, and then long term is less, but it's still like it was like 37% or something when we did it with him. So that's like a massive amount of tax on this money. He's looking at like 3.28 million on this $9 million gain. I mean, that's a lot, right? You do all the work, now you're paying a ton of taxes. So what we looked at is, if his short-term gains he's paying 50% taxes on, well, 37% is the federal piece. And so let's see here. BC was talking about California. You can't get rid of the California. California does not comply with federal stuff. So you still got to pay that, but the 37% on his 4.9 million, we can defer that with the opportunity zone. So that's how we're taking care of um, the short-term capital gain. Now, the long-term capital gain is a lower tax rate. So if somebody needs liquidity or something, it's like, okay, if you were to pay tax on something, that would be. So we're kind of splitting that, maybe some opportunity zone. Um, it looks like we have some depreciation from real estate that he gets to use, or some other depreciation. He loves equipment. This guy buys a lot of equipment, so he's going to use some equipment to mitigate taxation as well. And his net taxable gain now is 1.2 million. And so we're paying 340,000 in taxes instead of 3.3 million. Okay. So this is real life examples. This is literally happening right now. That's saving 3 million that he's going to be able to compound and grow, right? Maybe in 5 years that's worth 6 million, right? And then maybe if he wants to pay some tax, then he could. I mean, this is the impact this has on folks. Questions? Anybody? There are no dumb questions. You can ask verbally too, if that's better. Yeah. Damon asks, what is his exit plan on OZ? So, a couple things here. So, the equity in the OZ after 10 years is tax free. So, you don't need an exit plan. You can do whatever the heck you want with it. You can keep it in there, keep compounding it tax free, or you can get rid of it. I think you might be mentioned, I think what you might be referring to is that at 5 years, that capital gain tax is due, right? And so yep, okay. So the three things that typically folks do is, let's say there's a cash out refi in that project, right? If you're building a building, it's not worth as much until you get it built and then you have it filled up with people. Once you do that, it's worth much more. And then you refinance it, especially multifamily, into agency debt, Fannie Mae, Freddie Mac, HUD. Those have much lower interest rates, okay? And they will give you a lot of money back. So often there's a cash out refinance where you're getting cash back. I've had some properties where I put in 700,000 at the cash out refi, I get back 1 million. So I got back more than I put in and I still own the building. Okay. And that's tax-free money. So that's one option to pay the OZ tax. Another one is to sell the building after 5 years, take the gains from that, pay the tax, and the remaining gains go back to the OZ fund into a second building for 5 years. And then at the end of that, then it's tax-free. Another strategy, since he likes equipment so much, is in year 4, buy a bunch of equipment, take those depreciation losses, carry them forward. Depreciation is like a piggy bank. You have a dollar amount of depreciation that you get to carry forward each year, and you get to use like 80% of it each year. You can use up to 80% of it. And so I think his strategy right now is he's going to buy equipment in year four, carry forward that depreciation into year five, and then use that to pay the taxes. Um, there's a couple of that I'm forgetting, but those are the three main ones. What is the gains tax at year five? Good question. So another benefit to OZ 2.0 is the tax, it gets reduced by 10%. So he's paying 10% less. So if we're deferring, um, gosh, I would say 37%, maybe knit, so 40%. So that's like 1.6 million of taxable gain. So his taxable gain would be 1.6 million at like year five ballpark. So that gets reduced by 10% because of the OZ in urban areas. So instead of 1.6, it's like, 1.4 4 million. The other thing though is if projects are rural, that's harder to do because you got to have demand for your projects. It's hard to get demand in rural areas. Ski resorts, data centers can work. RV parks. I think I forget what it is. I think it's like a 30% reduction in the tax if you do that. So, that would be his tax. Um, what, Jeff, what potential risk are there with the equipment rental method? Yeah, Jeff, great question. So the typical risks that I see on these types of equipment deals are Ponzi schemes. They're not real. I've seen two big ones where they just totally went down because they weren't real. What I love about this one, it's a publicly traded company, right? Publicly traded companies are audited up the wazoo, so you don't have that risk, which is like the biggest one. The next one is like operations risk. Well, this company's a 4 billion revenue company. They're growing, they're doing fantastic. They're fourth largest right now in the country. They want to be number one in equipment rental. So they're going to continue to grow. So it's a thriving company. So operation risk would be one. The other one is economic risk. So in 2018, right, the whole mortgage loan thing, like everything imploded. Okay. So the auction houses for equipment in 2008, my understanding, they were selling new equipment 6 years later for about 40% of what you bought it for. Okay. So in our equipment model, they're buying it for 54%. At the worst economic time we've had in the last 30 years was 2008, they were buying it at 40%. Okay. So if you bought a million worth of equipment, that's a $140,000 gap from where we want to be. Um, our business guarantees a 9.9, so about 10% of that. So we guarantee about 100 grand in drop. So if we had another 2008 and it was time for you to sell your equipment year six, like all that timing kind of matched up with terrible economic timing and everything. The way I run the numbers, no guarantees, but this is how I run it for myself, is I'd be liable for about 40 grand of that million. I think those are the biggest risks. They've been doing this managed rental piece. This is why I love them since 2018. So they've worked out a lot of like the little kinks. Like picture 2018, one of the kinks was like, you might have 10 pieces of equipment, but one of them's in like Maine, right? And you're renting a ton in the summer, but it's like wintertime and people aren't renting. So they've been using strategies to kind of even out cash flows for folks. So you're good. You're not like short in the short term. Yeah, management fees for equipment rental. It's about 3% in total. So there's like insurance is in that, repairs and maintenance is in that. So it's like all the little things that could pop up, or we're kind of pooling up funds to pay for those, right? Just like I do in an apartment building. Like, oh, we needed a repair, so that's paid for. So yeah, about 3%, Damon. Good question. Um Okay, any other questions right now? Any other questions about this slide? And Damon, if you go to ownafleet.com, um, ton of information if you go through that. So, okay, so give you some examples. I want to be kind of transparent. Feels weird being like, this is what I do, but I want to be transparent with folks and really help folks find solutions for them. And, I do a lot of things that work, I do things that don't work, but this will give you a sense here too. Um, yeah, so rolling equity. So let's say you got out your hammer and you built an addition onto your house. Okay. You getting out your hammer and building on an addition to your house is not taxable income. Okay. Does it increase the value of your house? Yeah, if you did a good job, but it's not taxable. Okay. So a lot of the stuff I do, I try to think of a way as like, how can I add value that increases the value of something? And then I don't get paid on it until I sell the asset. Okay. So I might do $1 million worth of energy into something, but I don't have to pay taxes on that until we realize that $1 million. Okay. And if we 1031 it, then there's no tax, right? We just roll into the next one or we OZ it. That's a deferred tax. So, um, the title of this is change what you own so you change what you owe. So I'm trying to help people think in ways. We're all trained in school. What do you want to be when you grow up? It's all about jobs, right? Oh, I want to do this W2 job, this W2 job. So I'm trying to get people to think in different ways. So doing work, like adding value and not getting paid for it is a great way um, to grow your nest egg. This is like the whole cash flow versus balance sheet. People are like, cash is king. I'm like, yeah, cash is king, but and I like cash. I'm not against cash is king. I think it gives me a lot of flexibility to do a lot of things. But on the flip side, I love cash because it allows me to do developments, allows me to borrow money, it allows me to sleep at night. Why I hate cash is I have to pay taxes on it, and two, inflation. I believe inflation. I mean, I think we're really like actual real inflation. If you had to ask me, I think we're probably going to average like 6% a year, right? And so I don't want cash. I don't want my cash getting devalued. I want it going somewhere. So um, that's one strategy I use. Um, so yeah, doing work using OZ or 1031 for capital gains. These are incomes, I guess. Distributions from real estate. Yeah. So there gives you like an example. I do my tax planning. It's very complex every year. It's probably like 4 pages of me putting it all in, and then shooting it to my CPA just to see if I missed anything. No one's gonna like know your taxes like you. So I really appreciate my CPA, but I don't ask him to do my planning. I do all my planning, and then I just send it to him for revision to see if I missed anything. Um, so yeah, rolling equity, like not taxable, right? You add an addition to your house, not taxable, but it increases the value of your house. Cap gains, so I updated this. This should be like 1 million less. Um, when I build buildings, I get to depreciate them, right? And so I get to take that depreciation when I finish the building. When I get certificate of occupancy, usually I'm depreciating about 30% of the value of that building. 1031, when I sell a building, try to roll the funds into the next development or redevelopment. Interest expense, you get to write off interest on debt. So debt is super great if you can figure it out because cash out refi, like I said, tax free. Interest expense is deductible. And then the other thing is like inflation. If I have a fixed rate 30-year loan at 5% and inflation's really 6%, I'm making money, right? So when I think about how do I beat persistent inflation, because we have persistent inflation because we have this massive government debt, right? And so if you just kind of like research it, like the only way to like survive is to like inflate it away. So I think we're going to have persistent inflation. And if we're going to have persistent inflation, one of the best strategies is to have fixed long-term debt. 30-year loan, 25-year loan, not the one that reprices where you have to get a new interest rate in 5 years. No, fixed 25, fixed 30, fixed. Some of my loans are 40 years. Um, this should be higher and this should be lower. I always use equipment. Real estate, the returns are high, compound, so I always focus on real estate. But at the end of the day, if there's anything left over, that's when I do the equipment. And so this number will probably be about 10 times that this year, I would guess. So total offsets, total tax of income. So that's 2.45 million that I can roll into my other real estate developments and just keep compounding things and creating value for society, right? We're creating housing, a ton of housing, workforce housing, market rate housing. We're creating cool housing, right? Not ugly boxes. Everything I do, I have to love it. It has to be sexy, like build cool stuff. So we're building cool stuff for my community and meeting a lot of great community partners, council members, city council members, administrative folks at the city, at the state, wealthy families who really try to give back to the community. It's been really rewarding. So, okay, so now you've kind of understood the playbook. We had the DIY, we had the income investor, and then we kind of have the stuff I do. You can see the impact, right? You could be taking this and investing it every year, compounding it. These aren't guaranteed returns. This is just, my personal experience, and these are my actual returns and what I'm putting money into. It's not multifamily. Sometimes it's townhomes, maybe some flex industrial, just whatever the community needs, and the numbers work great. Um, yeah, if you got questions, text is the easiest. Just text me. If you want to set up a call and go over stuff, um, Andrea, can you post this in the chat again? Oh, you already did. You're so good. You just book a call. Okay. That one took a little longer today, but this was a lot of like deep, deep stuff that I mean, I could spend an hour just talking about pretty much any one of those subjects. So a lot to cover, and this is a lot of impact on your life. So I didn't want to skip over things. What questions you guys got? You can ask verbally, you can chat them, whatever works better for you. Oh, sorry, Yusuf. I'm new to almost every type of syndication. Okay, so syndication, Yusuf, just means pooling of money. That's the definition of syndication. When most people talk about syndication, they're talking about like capital raisers raising money and then putting it into real estate. That's the most common definition that I've heard. So I think that's what you're referring to. 100 grand, yeah. Then we work with your real estate development and we get some early returns. And then we're done with the deal after 5 years and we get initial back and again in percentage of profits. Yes. So, I do a lot of different projects, usually about three a year, one every 4 months, just kind of slow and steady. Um, Once we get a project to a point where I'm pretty clear on how it's going to go, then I invite my clients, my friends to invest with us alongside me. I'm usually the largest investor, so you're by far, and it just depends on the deal. And then you're investing alongside me. Um, Most of what I do is development because that's how you create returns, real returns, sizable returns is development. In development, you start getting returns after we refi. So if we refi, you get cash there, a chunk, and then monthly you get after that. And then 5 years is a nice timeline when that happens. Like I said, this one is probably going to be less than 2 years. But you just never know how the market's going to be. And sophisticated real estate investors like to have a 10-year mindset, okay? Patient capital. So I frame all my deals now as 10 year. You're in for 10. What I've seen is, things are really good. Um, I talk to the investors and I'm like, hey, like market's super hot. I think this is as good a price as we're going to get and as good a returns we're going to get. I think we should roll this into the next deal, or you can take your funds. Sometimes I'll do that at year two, year five, earlier, but I think you always want to have that 10-year mindset. I think is the healthiest. So, and my next webinar, Yusuf, is on vetting capital raisers, syndicators, is part of that. And so I'll teach you how to vet me. Again, syndicators are a little different. Syndicators are capital raisers. Their whole thing is pooling money. Think about like a financial planner, right? They have their assets under management. They're managing stocks for folks. And evidence is showing they manage them worse than people just doing dollar cost average into index funds. But anyways, they're doing that, right? And so that's not who I am. I'm a real estate developer. I'm a contractor. That's who I am. And so the syndicating, the pooling of money isn't my primary job. It's just a job that is necessary to do real estate developments. So I think that's the main difference between what you would typically see. Most folks are capital raisers. I act as a capital raiser with about 5% of my brain, but primarily I'm a real estate developer. My hands are on it. When I was in dentistry, I learned if my hands weren't there, if I wasn't active in a practice, the profits, the positive impact on the community would revert to the average, right? So I want to be involved in all these projects. I want my hands on all of them so I can create these larger returns, these more positive impact for the community, like do cool stuff. So great question. Abraham, you mentioned sending in your tax planning to your CPA. Resources like this are great for learning. How would you recommend learning more about the tax code to get that level? Because right now I rely on the CPA for a lot of this and telling me what to use. Yeah. So Abraham, what I've been doing lately is I've been using ChatGPT has a desktop version called Codex, and Claude has a desktop version called Claude Desktop. Okay, so these are actually quite smart. And what I do is I would like take my presentation, upload it, right, and say, hey, I've heard about these things. Upload my presentation. Upload anything else you've heard and say, hey, I'm interested in all of these things. Here are my goals, right? I want to mitigate taxes now and I want to, compound my nest egg, right? And you just keep asking it questions and ask you to build out a plan. The other thing is ask AI to build you plans in HTML. Don't ask them to build you in like Excel or Word or it just gets all screwed up. Just ask it to build everything for you in HTML and create a way to save it. So all my stuff now I build in HTML and it's saved on my computer. And then when I want to like send it to somebody, I just have a save as PDF button. It makes beautiful things. That's how I do it, Abraham. And so the other thing I'm doing now is taking my tax planning for the year, which I usually do in Excel. It's this big messy thing. And now it's like cash flows, potentially taxable income, the solutions, right? It's like 4 pages of Excel. I'm putting that into AI and working through it with it, right? So I can tweak things. It's just super helpful. So Trevor, always pleasure to have you. Mina, always pleasure. Um, okay, what other questions you guys got? Is ownafleet.com live? Yes, it should be. It was this morning. Yeah, ownafleet's live. What other question? This is one of my passions. Real estate's a passion, and then optimizing personal plan is also a passion of mine. Oh, I see a hand up. I apologize, Damon. Damon, if you want to unmute, I think if you meant to raise your hand, you could do so.
No worries, I didn't. Just thanks so much for your time. I appreciate it.
Yeah, anything I can do to help. These are just things I've done in my personal opinions, but anything I
I
can
did
do to
have
help.
a question actually, just now that we're looking at own a fleet, because I'm super interested in exploring that. It says based in Dover, Delaware. Do you just have companies that are just based out of different locations?
Yeah, so different states have different like structures that make them better to set stuff up in. So
Mhm.
typically, like a fund I'll set up in Delaware or maybe Wyoming, right? And the business I do is all over the country, so it's not like when I was like in dentistry, like treating mouths in a specific city. So
Cool. It
yeah.
must get complicated for your CPA.
Yeah, he kind of leans that way though too. I think he really likes helping folks, and so he would rather have a complex life than have a simple life and just not provide as much value to people.
Keep it exciting.
Yeah, yeah, yeah. Don't want to get bored. So
Well, thanks again. Appreciate your time.
my pleasure, David. Um, Anybody else? No question is this is the time to ask. I mean, if you have one-on-one questions, you can text me, like I said, or set up a call. But if you got something off the top of your mind, I'm here. Yes, Rio, there will be a recording. Um, Absolutely. It's hard for everybody. I mean, I think we had probably 20% of the people who signed up for the webinar show up. Some of that's like, out of sight, out of mind, but I think a lot of that's, for me at least too, is the schedule, right? It's always hard to match up. So there will be a recording and we'll shoot out the deck as well. So. Yeah, good question. So when's the best time to kind of reach out to me and start doing this kind of stuff? Number one thing always is focusing on your business, like growing your real business, a beautiful business, right? That's number one. And so any money you have at the beginning, I really recommend putting it into like learning dental insurance, learning implants, getting a dental business coach. I have four or five that I really would believe in, like good guys that I've known for, a decade. That's where I put the energy first. Once you kind of have those things in place, you've learned insurance, you've learned implants or whatever you want to focus on, you have a business coach in place, average dental income, for instance, let's say is like private practice, maybe 300K. You know, if you're ambitious, you're getting up to 500K, 750K, right? Most of my folks I work with are 750 to 3 million in yearly income. So I would say, yeah, we can chat in any time, but once you're at like 500, you're kind of getting there, but 750 is probably when it really starts to make sense. So that's when the tax pain starts too. So, um, any other questions? BC, any California questions? You want to chat about? Cyrus, George Foster, Jason, Jeff, Jonathan, NRK, Yusuf. Any other questions, guys?
I may pass this along to my brother-in-law. Um, he does a lot of real estate. I think you'll find some value in it, but is there any, um, I mean, I assume the more the merrier.
Yeah, just no assholes, Jonathan.
Yeah.
So,
Yeah,
in
he's
case
out. Sorry.
I mean, there's the yeah. I mean, any brother's probably an asshole just because you guys razz each other, but yeah, like all the people I work with, they're just good people, right? High integrity. We have alignment of value system, and then we have alignment of vision, right? I kind of like paint the picture. Please ask questions so you make sure you know what bus you're on, and as long as you're high integrity, good value system, and you know where we're headed, then it's very synergistic for the long term. So, um, yep.
Cool.
NRK, keep grinding. Yeah, and NRK, if you're not at the 750 mark, it's about working smarter, not harder, right? So surround yourself with super smart people. Like I said, like that buddy of mine that has a $14 million practice. I mean, he's not done yet. He's doing an expansion right now. He's probably gonna, if he keeps it up, I mean, he'll probably max out at 25 billion, I would guess, at that location. So it's just surround yourself with smart people, and then you're just like community leader, providing jobs for people, providing great dentistry. I mean, you can really just have a lot of positive impact and feel real good about it. So, um, no, he's not going to talk to you. He doesn't want to be a dental coach. But there's a lot of good dental coaches that are successful. Paul Etchison, dental practice hero, that's a good buddy of mine. He's legit. He's more expensive because he's been doing it a while, but his two guys that work with him, like the sub coaches, those guys are actually probably more successful than Paul. People always want Paul because he's the one on the podcast and the one they hear. But the other two coaches he has are probably more successful than Paul, Henry and Steve. So that would be a great coach for dental. Steve Vandegraff, lifestyle coach. Dude's a stud. So if you want kind of a practice that works for you, strong lifestyle, like dude's absolute stud. If you're just looking at like production and like sales and communications, Spencer Greer, he's the best at like patient communication I've ever seen. He produces like crazy. A lot of same day dentistry. Just gets people to say yes. He's fantastic. Um, those are the three. And I feel bad. I'm probably forgetting somebody, but off the top of my head. So yeah, and slides will be available on this, but those are the three guys I would reach out to. Whoever fits you best, whoever thinks you think are going to help you. All three of those guys are just studs. So, what other questions you guys got? The first name, so Paul Etchison. Again, great, but less expensive would be the two guys that work with him, uh, Steve and Henry. So I'd probably go with Steve or Henry. Henry's good at one big practice. Steve's good at multiple practices. Steve Vandegraff is another guy, lifestyle coach or lifestyle practice. Fantastic. And then Spencer Greer, just absolute stud with communication, closing. All these guys have built very impressive practices. Very impressive. Okay. Any other questions? Okay, everybody. Well, you have my contact info if you want to reach out. I hope this provided some good educational information for you today. Again, these are just my personal opinions. I'm not a tax professional, an accountant, or a attorney. These are just things that I've researched and I believe in. Um, and these are all, and I try to stay with things that the IRS and the federal government like want you to do. So just trying to help people see those and live a better life. And yeah, thanks for your time today.